Welcome back to We Get Mac. We're going to continue to learn about macroeconomics. So in this chapter, we're going to focus on finally applying everything that we've been talking in terms of measurements and even using the aggregate demand and aggregate supply model to understand how monetary policy can impact the economy. Okay, so more important than just going through the economic theory, I really want to emphasize the importance of this to your life and how this can impact you and assist you in kind of understanding and be able to even predict a little bit what can happen in the economy given the certain policies are put in place. Okay, so that's the idea behind this chapter. And to do so, we're going to review a little bit about the central bank. We're going to review a little bit about how we're going to talk about how they manage the money supply. We're going to talk about different types of tools that they use for that. And we'll talk about pitfalls of these types of policies as well. Okay, so to do so, we're going to talk a little bit about bank supervision, what the central bank usually do to be able to manage bank risk, and also depositors' ability to trust those institutions, because as we know, fractional bank is based on this idea that banks are going to be able to gather savings from us and then use those to make loans, right, in an appropriate way. But that depends on us leaving our money at the bank as well, because if we go and withdraw the money at once, we know that can cause bank runs. So bank regulation is going to be important here, and we're going to be able to also understand if there's an announcement in the news about bank regulation, right? What do you expect to happen? What kind of situation we face at this point? Okay, so that's the idea behind this chapter. And we're going to be able to understand how different monetary policy tools that the central bank can use, which you are probably seeing on the news right now, given the pandemic and the reaction of the central bank. And we're going to be able to understand what can we expect to happen in terms of changes in unemployment rate, changes in inflation, okay, and in terms of the business cycle. How are we responding based on what's going on in the economy? So that's the idea for this chapter. So very, very quickly, we're just going to review what the central bank is. So for the U.S., as you're going to know, I may mention his name as the Fed, since the name is the Federal Reserve for the U.S. Central Bank. Okay, it's supposed to be pretty much independent from the government, from the federal government. So they make decisions with the more monetary policy that are not, they don't call the government to say, hey, what are you guys going to do in terms of taxes so we can plan accordingly, right? They make decisions independently in terms of policy. That's important to mention. Okay, and as we all talked about, Jerome Powell is the current Fed chairman of the U.S. Central Bank. Okay, so we talked about all these functions before, and I'm not going to focus on all of them here, but we're really going to focus on, like I said, the role of conducting monetary policy. So that's the focus of this chapter. Okay, one way that banks can control the money supply is, one, regulating how banks can make loans, right? Also, it's important to know that, as we talked about, the main function of the Federal Reserve is oversees the banking industry so it stays healthy and stable. So to do so, the financial system depends on these institutions to make sure that there's no credit crunches, right? So make sure that banks can provide loans even during tough times, and also to make sure that there's no bank runs, like I mentioned earlier. Okay, to do so, we're going to learn how to evaluate these banks, which we talked about in the money and banking section, about the balance sheet of banks, and that's going to be used a lot in this chapter. So if you just ask yourself, what is that talking about? Please stop this video and go back to the previous one. On the previous chapter, we talk about money and banking and review the balance sheet of banks. That's going to be extremely important here. Okay, but how can banks be regulated? Okay, so take a minute here and think. And we're going to discuss this more in the virtual class. But I want you to try to think about, one, based on everything we talked about so far, what's the importance of a healthy banking system, and how do we know if banks are healthy, right? Second, I want you to think about, given that we know the traditional business models of a bank, because we talked about in the previous chapter, right? How do you think regulators can mitigate the risks that banks can get into in terms of, maybe they get into risky loans, right? Maybe they're not holding enough deposits. We already talked about some of those. So this is kind of a review, but also leading to what we're going to talk about in terms of this semester, of this chapter. Okay, and if we're in class, we'll do this in terms of groups. So please take those 5 minutes that we would already in class and write your thoughts down, because those are going to help us out. Okay, and I'll be back in a second so we can continue to talk about it. Okay, so hopefully you paused the video and you had some time to think about it and wrote down your thoughts, and I look forward to talk about it in the virtual class. Okay, what I want to point out here is that the things that we talked about in terms of the balance sheets of banks, what are the components, is going to be what we're going to relate to in terms of deciding what type of regulations can be imposed. Okay, so some of them is already talked about in terms of reserve requirements. We know that the central bank requires banks to keep a certain amount of deposits as their reserves, right, which cannot be loaned out, that actually stays in their vaults, right? So maybe changing that requirement can definitely impact how banks give out loans, right? We're going to talk about those. Okay, there's capital requirements, so a little bit more strict requirements in terms of how banks have to keep their balance sheet, how much capital they have to hold, in terms of how many loans they're giving out as well. Okay, and also restrictions on the types of investments, right? So they can ask banks to restrict the types of investments they're giving to the regions where the deposits are coming from. There are certain regulations like that. And anytime you impose restrictions on the lending market, you know that that's going to cause the market to change a little bit. And it's a question of whether or not it's going to come to a more efficient outcome after that. But the central bank is always trying to achieve that more efficient outcome. That's the idea. Okay. So a couple of bank institutions a couple of financial regulators that are part of the Federal Reserve is the OCC, so the Office of Controller of the Currency, that supervises banks and savings institutions. Okay, we're not going to cover this too much in depth, but I want you guys to get an idea in terms of the names of those institutions, in case you see that when your bank mentions on their website, or also if you see something on the news. Right, and also to know that they're different across different types of financial institutions. So for example, we talked about commercial banks versus credit unions, and credit unions are actually regulated by a different type of institution, which is the National Credit Union Administration. Okay, so it's important to see who is regulating your bank, because given that a policy changes by the OCC, and you are a client of a credit union, that's not going to impact your bank, and it's important to know that. Right. So more importantly, the Federal Reserve not only oversees this entire banking system, it also oversees the companies that owns those banks. So some banks, not only are they private, they are also owned by another company. Right. So that bigger company owns a bank, owns a investment bank, owns different types of companies, and that's important to know, because the company, the bank holder, the bank holding company of these banks actually has an important role in defining what type of strategy the bank's going to have, right? Your boss definitely impacts how you're going to conduct your business. So that's also important to be regulated. Okay, so maybe you didn't even know about that, but have you thought about, is your bank owned by another company, or does it not have any kind of banking holding company? And what are the incentives of your bank in terms of helping depositors, right? Or do they have different types of incentives because they're owned by a bigger firm that maybe just thinks about making loans and care more about returns than about safety and stability? So something I should think about, like the ownership of your bank is also important, depending on what type of services you're looking for. Okay. More important than all, as I already mentioned, it's really hard to be able to measure how a bank is doing. Why? As we talked about, and hopefully you wrote this down as well, so that's a quick review. One of the ways to check how a bank is doing is by checking its solvency, right? And its solvency is a difference between its assets and its liabilities, right? What's left of that is the net worth of the bank. And if it's positive, the bank is solvent. If it's negative, the bank is insolvent, and thus it cannot pay. Even if it sells everything that it owns, it cannot pay for its responsibilities for its debt. Okay. And hey, for you to be able to know how much a bank has, you have to be able to value the value of loans today, right? And for you to be able to do that, that's really hard, because you need to understand the market conditions, right? Why? Well, if you remember from our previous chapter, we talked about the value of a loan is just how much somebody is willing to pay for it. So how much other financial institutions would be willing to pay to buy that loan from that institution, right? And if that institution is not seen as somebody that is giving loans in a proper way, and they're very risky, or if market conditions are not helpful in a recession, and now it seems like people are not going to be able to pay back, the value of those loans can go down, right? Which can now affect the net worth of banks and how they're solvent, right? So it's really hard to measure how a bank is healthy, because it's hard to measure those assets. Okay, and part of the job of those regulatory institutions is kind of do that, be able to oversee that and find ways to regulate them where we don't depend as much on be able to find the value of those assets in such a perfect way, because that's really hard, right? So we're going to talk about things like that in this. One of the ways that we're going to talk about is that there's ways to provide, for example, against those two bigger risks. So we want to avoid big risky investments of banks, right? And we want to also avoid that people don't trust financial institutions, because that would take away the funds that the banks have to provide loans, right? One of the ways to control for the latter began actually in the 1930s, after a series of banks failed, and a lot of people stopped trusting those institutions because they lost their money, right? When the bank failed at that point, you couldn't get your money back. You just lost everything that was in it. It's like somebody stole your safe. You can't get that money back, and there was no interest behind it. So the Federal Reserve actually came up with the FDIC, the Federal Deposit Insurance Corporation, which actually does that. Allows us to be feel a lot more safe about our deposits, because up to $250,000 today, based on today's law, they insurance your deposits in the U.S. commercial banks. Right. This means that if that banks fail and you have up to that amount in your checking account, you would get that money back from the Federal Reserve. Okay, and that's probably why. And you've seen, if you're in class, you've seen me ask this question before. How many of us woke up this morning and checked how your bank was doing, evaluated how its balance sheet was in the previous quarter? Right? Maybe you don't even know, besides the name of the bank and how much you have on your account, maybe you don't even know all the services your bank provides. So as you can see, the provision of this insurance has pros, because now we're not worried about it, so banks are more stable. But there's also cons in terms of now we're not maybe checking as much how our banks are doing, the ones that we have our money in, because we trust that those institutions will do so for us. Okay. So discussing that and talk about insurance, let's consider that to a deeper level. So I hope you take a minute here, and once again, feel free to pause the video and then ask yourself this question: what do you think about this policy? Do you think there are cons to this policy as well? And think about how banks would react in terms of their business models, knowing that now they have pretty much an insurance company backing them up. Okay, so pause and take a minute to answer. Okay, so hopefully you paused the video and you took a second to think about this, and we'll talk more about it in the virtual class, of course. But kind of wrapping it up, which we're kind of going to try to get to in the virtual class, is there's goods and cons, right? The goods here, the pros are the banking system is a lot more stable in terms of the depositor side, because we don't see fluctuations on withdrawals as much, right? Because we're not doubting that our money is going to go away. We trust that the Federal Reserve is going to pay us back. Now, hopefully, one thing they could think about is what is the impact on somebody that is giving out those loans, knowing that if he fails, it has somebody that can pay out those clients, right? Maybe they worry a lot less about the clients now. Maybe they're a lot more worried about profits now, right? If that's the case, maybe they'll get riskier, right? Also, one thing that comes in is that, and we'll talk more about it later, another big function of the central bank is being the lender of last resort, right? So it's also providing this insurance to deposits, but also provides insurance in terms of providing loans when needed to those banks when they're really, really in trouble, right? So it is important to notice that there's consequences to being able to help those banks, but there's also pros, right? So for example, imagine in 2007, series of bank fails happened because of bad investments on the housing market, right? On derivatives, and we talked about some of those on the money and banking class, okay? So when those banks failed, what should we do, right? It's kind of the same idea of the deposit insurance company, like corporation. There's pros and cons to that idea too. In this case, if banks started to fail, we need to help them out, because if they're failing, we cannot get credit, we cannot borrow, the economy is not going to function as proper, right? So that's not good. So we need to help the banks always to recover. But if we're always helping the banks to recover, what's the incentive of banks to then act in a proper way? They can be a lot more worried, once again, about making profits rather than worried about us, because they have an institution that is doing that for them. And once again, if they go bad, somebody's going to help them out. So for example, in 2007, several of those banks that failed got bailed out by the central bank. Okay. Oh, so Eddie, so you're saying that they should not have helped them out? No, there's definitely consequences to not helping them out. Oh, well, we're not incentivizing the market to be efficient. We're not allowing banks that are not being efficient to fail, because that's what an efficient market would tell us that should happen, right? But at the same time, imagine the consequences of letting them fail, right? That credit crunch would be even larger than it was. And are we willing to suffer those consequences to let that market adjust? That's the question that we need to start asking ourselves, right? It's not which decision was right. We can see the pros and cons of both sides. So hopefully you can think for yourself, which one do you think is more important? And you can start making your own view about what can be done in terms of policy and what you tend to support more. Okay. So yeah, hopefully you join us in the virtual class and we talk more about this. But hopefully you enjoyed this video, and we're going to continue in the next video, talk more about how the central bank executes monetary policy.